Hi, everybody, and welcome to the Middle Class Investor. This is Seth Martin. Thank you for joining them again this week. Well, Friday, the market was met with some pretty broad-based heavy selling. And so this was one of the possibilities we thought might happen. And so it should be no surprise to middle-class investors out there that are listening to this program that this was something that was not probable but possible. So what I have up now is the weekly chart of the S&P 500 index, and I'm just before we go to a daily chart and talk about what we might do or what we might see next, I want to talk about each one of these is a week, okay? And so we had a pretty strong push up here. See, 1, 2, 3, 4, 5 weeks, and then we started this kind of sideways trend that we talked about. And then on the week before this past week, we got this candle right here. Now this candle actually means something. So this is called a it could be called a shooting star. It could be called an inverted hammer. It's actually not a shooting star because the body would have to be above. I think it would have to be above here and above here. So it's probably an inverted hammer. But that's not what it's called. Is not what's important. What's important is that the market opened here at this bottom part. The bulls pushed it all the way up here to the top of this, what's called a wick, to this upper trend line that we had drawn on there. And then the bears came in and pushed it all the way back down in here, almost to a lower close. So it finished higher than it opened for the week, but just barely. And this is fairly bearish. Now, this by itself, you don't really, it doesn't really mean anything. I mean, it means what I just said, but you can't make it mean anything in terms of what the future looks like. You have to wait for confirmation. And so the confirmation is the next candle. And so the next week, the market opened here. It looks like it ran up just a little bit into this area, and then the bears pushed it all the way back down here, almost to the low of the week. It looks like the bulls kind of came in at the very end and pushed it up a little bit. So this confirms, this red candle here confirms this inverted hammer. So this is just a pattern that's very common in the market. If you go back here, you'll find it. You can find it over and over and over again. And it's usually met with more selling. Now, is it met with more selling immediately? Not necessarily. It could just mean more selling after we get a little bounce, and then there's more selling. But I just want to make you aware of it because it is an important. The way this thing looks, it tells you real information about what's happening in the market, and it's pretty easy to spot. Just like this one's easy to spot. Here's a hammer at the bottom of a downtrend. A hammer at the bottom of a downtrend usually means there's going to be more upside. It was confirmed here the following week. So this is an inverted hammer at the top of an uptrend, which usually means there's going to be some selling coming down into this way. So anyway, I just want to make you aware of that. Let's zoom back out and let's go to let's look at the bond market before we switch to something here, because one of the things we talked about on the bond market, let me back up for a second. If you can see, the bond market has been going down. It's at the bottom of a pretty long downtrend. I mean, you can see this downtrend kind of started back here, kind of in 06, and has been chopping its way down in here to the lows around mid 2012. Now, and it's made an initial move up. And if you go and you analyze these highs and lows, like on a larger term basis, like a monthly basis, you'll find that this downtrend really didn't end until right in this area right here. So what do we have? We have a downtrend with a low and a move off this low. So the reason I was talking about this and how this what does this mean in the overall stock market, and possibly in your 401ks if you have bond funds and things of that nature, is we've had this initial move off the bottom. And what happens anytime you have an initial move from either a top or a bottom, you get a pullback into support, and then usually the trend will continue. So we had talked about this little pattern here. Let me zoom in a little bit. We had talked about this little pattern here, this little triangle pattern, and we had talked about that it was possible if it broke out, it could come up here into new high area. But that what I said is that this didn't look like this was enough. The width here wasn't enough to push this to new highs, and so what might happen is we get a little poke out and then a return back to this direction, which is what happened. This is actually pretty common too if you follow the markets. So we call it a fake out. So I think what we can expect now, if the market continues to sell off, you'll see the 10-year Treasury make its way down to this 2.5, 2.4% interest rate area. And I think I said, look, if you're thinking about buying a house and you're going to live in it for a while, hey, why not get a low interest rate loan? If you're thinking about buying a second home, I don't know. Well, it all depends on whether or not you can afford it. So anyway, again, what happens is that the market sells off, money starts to flow into this market. This is the most liquid market pretty much in the world. So what happens, money starts to flow into this market, which drives interest rates down. Now, and then about that time, you'll get a bounce in the market. So the S&P 500 will bounce and go up, and then money will flow out of this and start to resume its uptrend. That's the dichotomy of the bond market versus the S&P 500 market. So look for that to continue as the weeks and months trudge ahead. So let me go back. Let me go back to the S&P 500, and let's just go to a 9-month chart. Well, hold on a second. One of the things you'll notice on this weekly chart, well, I guess it was more like on earlier when I was looking at, it looks like this is broken out of our pattern, but it actually has not. So when we zoom in and we go to a 9-month pattern, I guess it's just kind of a glitch in the software or something. But if we go to a 9-month pattern, what you can see is that we're headed toward this lower trend line. So let's talk about that a little bit. And what I'm going to say here is not going to happen every time, or it's not something you can count on every time. But I want to talk about it as a potential possibility. Well, I got something crazy happening here. Let me try this again. Sorry about that. A little technological issue here. Okay. So there's a couple different scenarios I want to talk about. If this comes down and kind of stops here and turns, I would say that's fairly bullish. I would. A lot of times these trend lines, everybody's looking at them. So if the market were to come down here, and just kind of touch this line and then bounce from here, I would say that's fairly bullish. What I think, what I'm going to prepare for, let's put it that way. This pattern you see sometimes in the market, although it's it's not real common, but this broadening pattern here is usually a trend terminating pattern. That's the thing that I'm more keyed in on, is that this broadening pattern here is usually means a trend is coming to an end. And it always happens at the very end of a trend. It doesn't happen in the middle of a trend. It always happens at the very end. So I guess what I'm looking at maybe happening, or what there's a couple different scenarios, but I think the probable scenario is still, we slice through this support box pretty good, which means this is no longer support. Well, new support, from this area is down here. Well, what does that mean? I mean, that means, obviously we're not going to go straight down there. So I think what you can expect to happen here is maybe get, a little bit of a bounce. Whoops. You get a little bit of a bounce up here over the next couple of days, maybe into this area, maybe into 1850, 1860 area, and then we break the trend line with the next move down, and this would be new support. So we'll draw this box on here in a minute as the new support area. And then, there's going to be, as a middle-class investor out there, you're going to have to make some decisions. And the decisions are basically, do I want to roll the dice and see how low this can go? Or do I want to step aside and let things happen the way they're going to happen with me on the sidelines? Those are the types of decisions you might have to make. Now, let's just talk about economic cycle for a second, because some people are, there's a lot of people talking, the talking heads on the news, and they're saying, the interest rates are low, and this is, it's not the kind of environment that the market would go down in, and blah, 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 blah. Okay, so, but here's the other reality. If you look at cycles in the market, if you look at bull cycles and bear cycles, what you'll find is that, a bull cycle lasts maybe 5 years. Well, look at what we've got here. We're about 5 years. So I think the difficulty is, the thing I'm really worried about is the interest rates are still zero, and it's about time for a new recession. So I'm not sure what the Fed is planning on doing, except maybe reversing the whole taper thing and printing more money and buying bonds. That's probably what they're going to do. But I just want to point out that these cycles, these bear market cycles, bull market cycles, they last about 5-6 years, something like that on the bull side, and then 2.5, something like that on the bear side. So, and that's a long one. Sometimes they're much, much shorter than that. But so when you talk about that in the context of this pattern, the price action, the amount of unemployment, just the economic factors that are out there, I think you're looking at a pretty high probability that there's going to be some sort of correction here. Now, what we don't know, is it going to be 10%? Is it going to be 5%? Is it going to be 35%? But here's what we do know. If you go back and look at, if we go back, I'm going to go back to a daily chart, and I'm going to zoom in on this blue box right here. Let me get a 10-year up, daily. And I'm going to zoom in on this blue box, because here's what I'm trying to help you avoid. When the market runs up and you get a sell-off, this is a pretty significant sell-off. Now, this particular one pulled back to support. Well, I tell you what, let's look at it on the weekly, because maybe that's, if you're managing a 401k, maybe that's the better way to look at it. But look at this pullback. This is a pretty strong pullback. And then what did it do? It retested. It bounced, okay? This is the area where I'm suggesting that you recognize, now maybe not right here, but maybe a break below this low here, you step aside, because look at what happens, okay? Now, some of you are saying, oh, well, hindsight, that's easy. It's easy to see. Yeah, but this happens over and over again. So here's another one. Here's a big move down, retest, and then sell off. Okay, so these are the types of areas you want to avoid. So let's zoom in here. We're still on a weekly chart, so I'm gonna do some drawing here. So, let's say you get a break of this. You get a break of this. This travels down to here somewhere, and then we get a retest. The underneath side of this this wedge pattern. I'm suggesting that if we break through this wedge pattern, a good trade, a good way to handle this is wait for the bounce and then sell. Once you've had a significant portion, let's say half of this move, if you measured this move, and let's say this move was 300 points, and you had a 150 move back up, sell right there. Okay, so that's how you might handle this. Because generally speaking, after your first move down and a test back up, the next move down, the third move down, is more significant, much more significant than the first. And we can go back and we can see that here. You can see it here. Here was your first move down, retest, much more significant move. You go to here. Here was your first move down, retest, much more significant move. So now you might be saying, well, that's not so bad right there. I mean, look at that. That's not that much. Well, let's measure that from high to low. That's 16%. But remember, that's just the first part. This went on and on and on and down to here, which was like a 60% move or 50% move. So I'm just suggesting to you that you don't have to live through this. You don't have to own stocks or own whatever you own through a move like this. You can step aside, let all this happen, and then look for an entry back in. And we talked about that. We talked about how you might look for 2 weeks in a row of up movement. In this case, you would have gotten in right around in here. Let's say it's 770, 780, something like that. That's still a heck of a. You saved yourself a lot of money, and you're positioned for the next bull market. Okay, and if you go back, you won't see two up weeks like this anywhere in this downtrend. So it's a pretty good way to get back in. So, but what we're going to be focusing on the next several days. I'm going to be looking at this over the next several days. We had a break of support. We're pretty close to the bottom of this trend line. I'd say we're probably looking at. Let's zoom in on this one. We're probably looking at a move like probably back up into this area right in here. What is that? That's about 1850. And then you're going to be probably likely met with heavy selling. Now, the other scenario is, I mean, it could just kind of test up in here and then come down here and then bounce. Any bounce off this trend line is still bullish, but like I pointed out before, there's very little room here anymore. I mean, from here to here, from 1930 to 1840, there's about 100 points. So if you caught the actual absolute low and rode it to the absolute high inside this pattern, you might get 100 points. What I'm suggesting is the downside risk of trying to do that is maybe 500 points. So, you're really kind of playing with fire if you're holding out for the every last little inch of the move. Now, if you want to stay in and play a bounce into the mid area of this, I think that's reasonable. But it all depends on your rules and how you're positioned with your 401k, and how often you can get in there and do stuff, and how often you can make a move and things like that. Some people are fairly restricted there. What I would do, though, is I would, getting back to, let's go back to the bond market for a second. I would watch this bond market very closely, and if I had bond funds, I'm talking about me, which I don't, but if I had bond funds, I'd be looking for this to come down into this area, and then I would just sell my bond funds. Because this next move, this next, say, 3, 4, 5 month move is going to be pretty significant to the upside. Just start watching the 10-year Treasury. It's on the little scroller ticker thing, and you can watch it. And they always show the interest rate. So it'll say 10-year yield, 2.619, up 500s or something like that, or down 500s. So just keep an eye on that. That's about all I have for today. I think we're just going to have to wait and see which one of these scenarios plays out. I think now that we've broken support, I think there's a fairly high probability. Let's call it 50-50 at this point. I think there's a 50-50 chance that we come down a little further Monday and bounce off this support, in which case I think that'll be bullish. But if we just turn tomorrow and start coming up a little bit, and we only get, let's say, into this 1850, 1860 area, and then it starts coming down. In fact, if it comes down, let's say it just does that. Let's say it comes, it goes up a little bit into this 1850, 1860 area, and then comes down and breaks 1800 and slices through it. Well, then I think you got more downside. You got to move maybe down into the potentially down in here to the 1640 area. So you're talking about 150 points or so, 175 points on the S&P 500. So what I want to do is I want to try to keep you out of that if I can. But you have to be willing. You have to be willing to take the action. I can kind of guide you through the shark-infested waters, but if you're not willing to take the action, or if you're frozen with fear, if you're sitting there, I don't know, I'm just going to wait, and what happens is you end up not taking action, and every day it just goes further, and then every day that you get closer to the bottom, that makes that decision that much more poor. The best decision you can make is maybe right here in this area, but as you get down to this area, then you make the decision, well, then it's about time to bounce and come back up and retest this area. So you have to be decisive. You don't have to take, it's not a lot of risk, really. It's not taking more risk. It's being decisive, taking action, pulling the trigger, and then knowing where you're wrong. Okay, so I have a thesis, it's going to do this. If it doesn't do that, then I'm wrong. Okay, and you reload for the next decision. Okay, that's how investing in this type of market needs to be. Now, for the last 5 years, I agree. You just roll it all in, go to sleep, go to work every day, don't worry about it. But we're at the end of this run. You want to keep the money that you've been able to make at this point, and you just don't want to have to, lose sleep over wondering what's going to happen. So, with that, let's end the show this week. I'll probably come back on probably after Wednesday. I think kind of what I've been doing is a video on the weekend and then video in the middle of the week, like Wednesday. And come back, subscribe, forward the YouTube link to your friends. Certainly, people that you think have a desire to be a little bit more active, feel like that. Some people just don't have a desire to be active. They just want to put their money in and don't do anything. And that's fine, but that's not what we're talking about here. What we're talking about here is missing a 50% down move and then capturing the 100% up move, and then missing the next 50% down move and then capturing another 100% down move or up move. That's what we want to do here. So if you have friends and family that are interested in that kind of activity, then, forward them our link. Tell them a little bit about the show. Promote it a little bit if you think it will help them. Okay? Certainly, if you want to comment on anything that's said or you want to ask any questions, just go to the comment box and type in your question or comment. If it's something that needs to be responded to, I'll be happy to respond. And until next time, we'll see you then. Take care, everybody. Bye-bye.